Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
When I got to the bond trading floor at Salomon Brothers in the early 90s, which was by far the biggest bond trading floor in the world at the time, I was like, you guys aren't so special. Interest rates go up, bond prices go down, vice versa. Why are you guys so special? I learned there's a little bit more to it than that. And I guess our next guest will probably agree. Bob Michael, he's the CIO, fixed income, JPMorgan Asset Management. Bob, the Fed came through for us, I guess, with that 25 basis point cut. But I don't know what they're going to do in December. What is your market telling you? What are you hearing?
First of all, Paul, we are special. We can finance anything. Businesses, households, governments, entities. We're there.
Yep, absolutely. Including for Facebook last week, $30 billion in bonds, I think with 3 phone calls.
It was nothing. Don't mention it. So let's go back to the Fed. For sure, last week, it was no surprise that they were going to cut by 25 basis points. The dissents were a bit more hawkish than the market expected. Everyone knew that Stephen Myron would be a dovish dissent for 50 basis points, maybe even 75. And we thought one or two others might pile on. But actually, Schmid went the other way. And that got the market to reassess. And then we heard Powell's rather clumsy press conference where he tried to encompass both tail risks into what was actually a pretty clean consensus. To us, it feels as though they will be cutting again in December. We don't see a pickup in economic activity between now and the December meeting. Actually, the other headwind that's formed is the federal shutdown. So got a lot of federal workers out there who aren't collecting paychecks. I wouldn't exactly call that a tailwind to the economy.
Talk to us about demand right now for fixed income, and where is it coming from? Because I think there's a decent amount coming from outside the U.S., a lot of foreign interest.
Yeah, there's demand coming from everywhere. There's a sense that investors over the years are underallocated to fixed income. I get pulled into 1 or 2 meetings a day to talk to some form of client, institutional, on the retail side. They want to know where to go in the bond market. They have too much cash. The first thing I do is congratulate them. Great call. Why would you buy interest rates when they were 0 a few years ago? Right. And then the Fed raised interest rates, so bond prices came down. Now you're looking across the yield curve. You can buy treasuries at 4%, or you could go into the broader bond market at 5+%. And that gets a lot of interest. It is a lot coming from the retail space. There are U.S. institutions, there are pension funds and insurance companies that consistently go into the long end of the curve. And yes, overseas investors, after a pause back in April, May, after Liberation Day, are starting to come back into the U.S. bond market.
The Bloomberg U.S. Aggregate Index is up 6.8% this year. Solid numbers. And if you want to take some interest
rates. See, if you were in the equity market, you would have just rounded that up to 7%.
But I know
Give me the 20 basis points. Let's go with 7. Let's go with 7. It's Monday.
I got green all over the space. High yield, 7.4%. I'll round up there. I mean, there are some seriously solid returns in fixed income here. Where do I go from here? Do I just clip coupons here? What am I doing?
No, you start to get out of cash because yields are going lower. I think the broad consensus at the Fed is they're still a ways away from what they consider to be neutral. They're pretty close to 4%, and they think neutral is closer to 3%. So you've got a few more cuts to get through. We think you see at least 2 more, and maybe as many as 4 or 5. We'll see when we get there. If you're in cash, your return is going down every Fed meeting by at least 25 basis points. And if you're in a bond fund, you're not only collecting the carry. Every time they cut rates and yields drift down a little bit, you're getting some price appreciation as well. That dynamic is what's getting people in cash nervous about their underallocation of fixed income.
You would think that a headwind would be these concerns over the U.S.'s status on the global debt stage, if you will. It doesn't seem to be stopping people from getting into the market. Is the U.S. still the least worst option when you look at the global fixed income industry?
I'm not sure if it's the least worst option. For sure, there have been very large debt-financed economies out there. Japan, we've watched for several decades. China has joined the fray, and for the last 10 years or so, we've watched debt to GDP ramp up. What really caught everyone off guard was what was considered core Europe 10 years ago. So think of Germany and France suddenly throwing caution to the wind and starting to borrow and spend. And that caused investors to step back and say, hey, wait a minute. I might have been interested in rotating a bit out of the U.S. into the European bond markets, but if we're going to see borrowing and spending there, how much further can the ECB bring down rates? The U.S., there's going to be more borrowing and spending, maybe not as much as everyone fears, because there should be tariff revenue coming in, and perhaps a lot of that spending will be used productively, so create more tax revenue. So I think it's part of the narrative of why money is starting to come back to the U.S. again.
Bob, when we talk to fixed income investors and we talk about duration, they kind of feel, I think probably the consensus is kind of in the 3 to 5, maybe 7-year part of the curve. Yet when I see new issuers come out, like Facebook and others, and there's been so much new issuance in the fixed income market, investment grade and high yield, I see 40-year pieces of paper out there in some of these deals. What does that tell you?
They're really smart issuers, aren't they?
Yeah.
They look at how flat the yield curve is relative to the Fed funds rate. They know there's a lot of defeasing of long-term liabilities by pension funds and insurance companies. They know that overseas insurance companies look to the long end of the U.S. credit markets as a place to invest and defease some of their longer-term liabilities. So why not issue where there is demand? Why not put in place some longer-term funding? I'd also be careful about reading too much into it, because a lot of these treasurers at big corporate America are pretty adroit at hedging their yield curve risk. So they may issue a lot in the long end, but somewhere down the road, they could swap some of those liabilities into shorter liabilities as well. Liability
management is what that's called. And there's
Yes.
groups on Wall Street that's where do you work? I work in liability management. What?
Hey, that's an important.
It's a career.
It's an important division to be working in. For those who are not adept, and all-knowing in the fixed income world, it can be overwhelming. It can be confusing. Right now, where do you see the most opportunity?
There are a couple places. One, we still like corporate America. When our analysts talk to corporate America, and between our fixed income credit analyst and our equity research analyst, they talk to hundreds of companies a day. They're fine. They've absorbed tariffs. Tariffs are yesterday's news. Somehow they've managed to build that into where they source their goods and then how they're going to price them. Yeah, there may be a little bit of a headwind left, but they're mostly over the hump. So we like credit spreads in here as long as we don't go into recession. We don't see that looking out into 2026. The second place we like is securitized credit. We can buy agency mortgages at close to 1% above treasuries. Why not go there? And then lastly, emerging market debt. It's performed very well. Real yields are still high. Central banks are still cutting rates. There are some crossover flows yet to go into that space. So I would watch that.
You mentioned the ECB a moment ago. What do you expect them to do with rates?
I think they're on an extended pause. I think they're at 2%. They look at that as a zero real yield relative to their 2% inflation target. So why not just wait and see how things play out?
Boy, you mentioned agencies. I'm looking at, again, my INGO function on the terminal. U.S. mortgage-backed securities total return, I'll round up, 7.7% this year. So that's kind of the best we've seen out there. What do you make? So outside of the U.S. emerging markets, anything to do in Europe, anything to do in Asia, in developed markets here, or is that played out, do you think?
I think there's just better value elsewhere. Okay. And if I go back to April, May, when there was a lot of interest in diversifying out of dollars for both portfolio rebalancing ideas because of the overallocation of dollars, and also a bit of concern about where the U.S. was headed, and call it dollar retribution if you want it, that's ended. Clients are coming back to us and saying, no other bond market has the breadth and the depth of the U.S. Paul, what you should be asking about, a man of your means, is the municipal bond market.
I am all in. I'm the largest private creditor to the state of New Jersey, I like to think.
You should have a ladder of municipal bonds in New Jersey. Just get rid of those ugly taxes. Yep. Have that anchor in the storm. New Jersey will always be there. You'll be fine. The municipal bond market to us is the last area, which does look attractive.
It didn't start out that way this year, right? I mean, it sort of came to life, I'd say, I guess, in the third quarter. Why the turnaround? What happened there with the muni? They sort of did an about face there.
Well, for a very good reason. When the new administration came in, they made it clear that they were going to push a lot of projects that were paid by the federal government down to the state and local government level. So if you're a municipal bond specialist, you're sitting there going, oh my gosh, like how are these state and municipalities going to pay for that? They can't touch their rainy day funds because they're not rainy days. So there was a lot of issuance to do that. That cheapened the market up a bit. We look at ratios relative to treasuries. Mm-hmm. They got into the low 70s. Now they're the high 60s. So that's part of the turnaround that we've seen. But now there's a pretty good equilibrium between issuance and demand. Paul, start buying.
So I started laddering my municipal bond portfolio in 2000.
I like that, laddering.
2000.
And you started off saying you're an equity guy, and you're doing this under the surface.
Well, I told Tony O.C., I said, I've got enough equity market risk with my job working at an investment bank.
Laddering's next level, Paul. It's next level.
It worked out. You sleep well. Bloomberg Municipal Bond Index total return this year, 3.9%, which is darn good.
Oh, yeah.
Because that number was negative for a while. What we haven't seen...
It's your anchor in the storm. I started in the business when we actually clipped coupons and sent them in. I was at Bankers Trust. You'd sit there and clip coupons and put them in an envelope, and off they went.
2024 record issuance in municipal bond market. I think we're going to do even more than that this year. We just were down at the offices of Build American Mutual, BAM, and they're loving life there in the municipal bond market. We haven't seen any real credit problems recently. I don't recall. How is the credit quality in the municipal bond market?
Do you know, it's strange. It's the one thing I always ask our municipal bond team. There's always a problem in municipals. Yep. There's always a Puerto Rico. There's always an Illinois or a California. Like, where are they?
Yep.
And the reality is it's been a pretty healthy economy for a while now. We haven't really had a recession. We've had a couple flash recessions. Municipalities have collected a lot of revenue. The early days of COVID helped them a lot. Yep. There were some fiscal transfers, so they got to top up their rainy day funds. They're not really there. We'll see if they materialize over the next couple of years. But right now, it's a pretty good environment for municipal credit.
I'm a big fan of Jane Fraser, the CEO of Citi. I think she's done a good job turning that place around. I used to work there, so I do keep an eye on it. But she got out of the municipal bond underwriting business just when it was just exploding. So I don't know what's going on there.
I'm a pretty big fan of Jamie Dimon, and he didn't.
Yes, he didn't. And in fact...
well played, Bob.
New issuance. I mean, and what I learned about the municipal bond new issuance market, they don't raise money when rates are low. They raise money when they need it. So it's just, it seems like a pretty...
Is the timing working out for them?
I don't think they care that much, do they? I mean, when they need the money, they go out and raise it.
Well, we all live in a municipality, and we look around, and there are roadworks, and we all groan, like, just as they complete one section of road, they're working on another. So you'll never have, pure highways to drive on. And I think that's the reality of municipal finance, is that there are always projects underway that they have to deliver to their constituents and that we expect them to. So they're somewhat rate insensitive. And they often, these projects go for 5 to 10 years.
No, don't we know
they
it?
have to roll them over. Oh, yeah.
So, and you'll know, Bob, every Friday on my Bloomberg Intelligence program, we have a sponsored municipal bond segment. So there, I got it covered.
You're
Bob
more
Michael,
of a bond guy than you
I'm all
thought.
over it. I know.
You are.
Bob Michael, CIO, Fixed Income, JPMorgan Asset Management. He does it for a living, folks. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Henrietta Treyz, co-founder and managing partner for Veda Partners, joins us here. Henrietta, how would you characterize the President Trump's last week in Asia, particularly with his meeting with President Xi?
Yeah, the President Xi meeting was the big one. Everybody's determination is going to be focused on different things. But in my opinion, and from the perspective of DC, everybody sort of retreated to their corners. And that's going to be helpful for the next year. I think it has a lot of read through to how DC is going to operate for the next couple of months and how the Supreme Court is going to rule on these IEPA cases. But I thought it was really helpful to think about the president's first term and his last trade deal agreement with the Chinese versus this term. In 2020, when Bob Lighthizer was the USTR and he was the main negotiator with China, he was able to negotiate sales of soybeans to China of $56 billion over 2 years, 2020 and 2021. Now, if you fast forward to this past week, Secretary Bessent, the lead negotiator with China, he was able to negotiate just a $34 billion deal with China for soy over 4 years. So the first read through I get is that as a result of these trade wars, the U.S. market share in agricultural trade to China has not just dropped off. The entire thing has been a mirage, and it's really hurt the United States and the Farm Belt, and likely not to come back. So it was really comprehensive conclusion that the market share is gone. It is eroded. It's gone to Brazil and Argentina. And that is what the U.S. can count on with China for the foreseeable future. So that means D.C. really has to migrate to finding other alternative outlets for our soy, sorghum, wheat, corn, beef, cattle, all that stuff. And our trade agreements with other nations are even more important now, should the president be able to negotiate those.
And Henrietta, in your note, you said that soybean farmers saw this deal as pretty underwhelming. So I'd imagine that a bailout, a U.S. bailout for farmers is still very much on the table. What do you expect to happen there? I mean, of course, we've got a government shutdown right now, but when things get back up and running, hopefully, what do you expect?
Well, actually, I think this is actually really constructive for getting the government back up and running, because now we're going to need at least a $12 billion influx of cash for farmers. The $12 billion that China's going to buy this year, if they hold true to their deal reached with Secretary Bessent, is not nearly enough to keep those guys afloat. We don't have Chapter 12 bankruptcy data for farmers while the government is shut down, obviously, but that's something that is, I think, going to be the most important piece to watch when the government does reopen and we start getting data flowing again. But we're going to need a bailout for farmers. And the president doesn't have the authority to get that money out without Congress coming back and giving him 60 votes in the Senate to send the money out to U.S. farmers. So that actually gives the Republican conference a reason to come to the negotiating table and have a discussion with the Democrats on the Senate side. And I think that's going to be really constructive as soon as this week in getting things moving. We know the White House wants the bailout. The farmers need it as a result of the trade war. And so I think it is very constructive for getting the government open again as soon as this week.
As soon as this week, I'm not sure what the catalyst is, Henriette. What do you think the catalyst is for getting these two sides back together to reopen this government? Is it President Trump taking a more forceful role?
Well, I think the Republican conference is very much looking for guidance from the president. They don't like this idea of overruling the filibuster. There aren't the votes for that. But I would step out and say it's not so much Trump or Democrats or Republicans. It's that there's a recess coming up. You guys know that I always tether things to the calendar. They love a recess. They have a 10-day recess coming up on Veterans Day. And there's a big difference between being able to go home to your constituents for your regularly scheduled work weeks when the government is shut down, which is, of course, what the House has been doing for the last 5 weeks or so, and actually being able to go on your CODEL, travel abroad, have a little bit of a break and a vacation. The senators very much want want to have that. They've been in DC this whole time. So Friday starts what would otherwise be a 10-day recess for Veterans Day, and that's as good as catalyst as any.
Do you believe that we're really just kicking the can down the road here, though, Henrietta, at the end of the day? Because it looks like deadlines to hold China to its promises just keeps going further out into the future. And doesn't that sort of leave our farmers in limbo?
Yeah, absolutely. So that first trade deal I talked about, where Lighthizer was able to negotiate a 2-year deal of $56 billion in soy purchases, it ended up being a mirage. And that was in part due to COVID, of course. But now that share is dramatically reduced, $34 billion over 4 years. And they're not going to necessarily get that agreement from China to hold through. China famously negotiates by delaying, and they have not lived up to their soy promises in particular. Yep. So as we get into this, I think it's going to be really important. And that's why soybean farmers were underwhelmed. There's no specific dates. There's no metric tonnage. There's no break bulk commitments. None of those things that the farmers really want to feel certainty and security.
All right, Henrietta, thank you so much. Appreciate it. As always, getting your input. Henrietta Treyz, co-founder, managing partner, Veda Partners. She is our go-to voice on what is happening, or in this case, not happening in D.C. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Pat Haskell joins us here, head of the Muni Bond Group at BlackRock. Pat, the Muni Bond market has turned positive in terms of total return this year recently. Talk to us about the performance in municipal bonds, generally speaking, this year.
Sure. First of all, good morning. Thanks for having me. The performance did turn positive. September was the best September since pre-financial crisis. However, we had a really tough first part of the year. And what happened was we had two things. We had a lot of policy uncertainty as the new administration came in, whether it be around whether the exemption itself was at risk, a lot of the changes in Medicaid rules and how they would affect hospital credits, whether or not some of the large flagship universities endowments would be taxed and to what level. So we had all of those things. You had a little bit of a buyer strike. You had a lot of supply in 2024. We've had more supply, almost 20% more in 2025, and that led to a lot of cheapness in the market. So at one point in the middle of August, we were underperforming the ag by almost 500 basis points. So that has caught up in terms of having good performance in September, not completely caught up to that performance of the ag, underperforming treasuries by about 200 basis points and almost 300 basis points IG corporates. So still a lot of cheapness there on a relative value basis.
But now, of course, you're dealing with a government shutdown. And how does that impact the muni market? Because I'm thinking, ironically, it might help given the fact that there's no federal spending on projects. Does that now lie with the state and city municipalities, and do they need to raise by having new issuance?
No, to a large degree, and this is still reasonably short term. I mean, muni projects are really long term in nature now, but there's stuff that's been put on hold. That's not unprecedented. That's happened when both sides of the aisle shut down the government in the past, and it's usually short lived, 30, 60, 90 days, and then those projects are put back in place. To the extent that any of these projects, the large infrastructure projects, would be politicized, for example, the new tunnel under the Hudson River, that would affect the muni market.
Hey, Pat, you talked about the new issuance market. And again, we do a lot of work with the people, Build America Mutual, the BAM folks. We do some remote broadcasts from there. And they tell us 23 was a record year new issuance. 24 was a record year new issuance. 25 is going to exceed that, which has been a drag on performance. What's the outlook for 26?
So all that stuff's coming out right now. I think it's going to be a robust year for supply, but not a record-setting year like we've had now. So, still around 500 billion, but not well north of.
Boy, that's amazing. I mean, and what I learned in the municipal bond, talking to these experts here, is my question was, why weren't you guys raising money when this stuff was free? Now they're raising money when interest rates are higher. And I was schooled that municipalities borrow money when they need it, not necessarily when it's optimal from a capital structure perspective. I
think that's probably true. I think there's some municipalities that are better planners than others, but I think there's a little more to it. During the pandemic, when the money was free, and rates were at zero, if you came out of 20 into 21, state and local governments were short about $140 billion. Through a variety of federal programs, they were given $300. They didn't need it. So the federal government paid for it at that point.
Of course, you think muni bonds, you think tax haven, triple tax haven, but there's also something called a taxable municipal bond. It's a small part of the segment, but yet it's growing. Who's buying the taxable muni bond?
Foreign investors, insurance companies, banks. Municipal credit is stronger than that of its taxable counterpart. Munis default at about 0.1% of their taxable counterpart if you look at them on a ratings bucket basis. So that high quality, long duration exposure that insurance companies and banks can get, it gets eaten up.
So they've had municipal bonds have had a nice run here in the last several months, yet still attractive relative to treasuries.
Yes.
Talk to us about valuation. How do you think about it? How should we think about it?
So two things. One, as I said before, a little over 200 basis points underperformance versus treasuries, a little over 300 basis points versus investment grade corporates. But in addition to that, the curve is 75 to 85 basis points steeper in the exempt space versus the taxable space. So you're getting paid that excess spread there to take duration. So that's why I like the relative value.
Biggest headwind for the municipal bond market. We don't have a lot of clarity on interest rates right now, right? I mean, Powell last week said a rate cut in December is not a foregone conclusion.
So there's the biggest problem for the muni market is volatility. So, whether it's through a fund or through an actively managed ETF or an SMA or in a brokerage account, 75 to 80% of municipal risk is still held by mom and pop. When volatility goes up, mom and pop like to raise cash. And in a liquid market, that causes problems. So the biggest thing for us would be some unforeseen, very volatile market.
Credit quality has not been a concern for this market for several years, certainly coming out of the pandemic. Any reason to think that might change in 2026? Because we've had really nothing to worry about.
No, to a large degree, given that we still have above trend GDP growth. The muni market's in a very good situation. A lot of people like to talk about that we have debt to GDP ratios in our country of 125% and growing. If you did that same math for state and local governments, the number's 30%. If you took out a couple of the problem states, it's actually in the mid-teens. So no, in a macro sense, muni credit's at a good spot.
What's the sweet spot right now in muni bonds in terms of maturities?
So we like the 15 to 20 year part of the market where you can pick up about 85% of the value of the curve and get good roll down there.
Are there certain projects you like? Because I think in municipal bonds, we have a sponsored segment every Friday on Bloomberg Intelligence program. And we bring a reporter in here and I'll say, what's the crazy deal you're looking at? Like, is there something that's out there that you think is a little sector that maybe is a little quirky? I mean, not that higher education's quirky, but that's a sector that probably not something that's on everybody's radar screen. But is there a sector out there that you guys like that maybe is not mainstream?
Well, we continue to like flagship universities despite the volatility around all the headlines around taxes and things along those lines.
Are those state universities or are those just like a Harvard or something?
Could be Harvard, could be NYU, could be Cornell.
Okay.
If Tom was here, I would say, it's all the Rochester universities.
Sure.
But they're not just the state universities. We like some of the large transportation projects, toll roads, things like that. Some of the hospital systems, the multi-state diverse hospital system with a diverse payer base we like. There's a lot of good credits out there.
The Q train project's still on hold here in the city, right, to expand it. Or isn't that right? The 2nd Avenue train line, they want to expand it yet again. That's on hold in large part because of the shutdown. What about stadiums? I remember when Yankee Stadium sold bonds for the new stadium. That was a cool one to be a part of. Is that an area where you see some issuance?
It's situational. There's only so many sports teams in the country. Right. They tend to be good credits and they tend to offer you excess spread. But anytime you can, I always say the muni market's a purposeful market. Right, you get to see and touch, what you do and what you finance and what you're a part of,
which is rare for the
that.
investor. Yeah,
it's a lot of fun to be a part of.
Like the Dream Mall over in Jersey, or not? Maybe not.
Dream Mall.
Pat Haskell, thanks so much. We appreciate it. Head of Municipal Bond Group at BlackRock. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Lisa Mateo with the newspapers today. What do you got for us?
Yeah, those days when you had the black fingers from the day, those are gone. Okay, so this one is from the Wall Street Journal. It talks about this change in the workplace with companies moving away from labor hoarding. So if you remember after the pandemic, right, the companies were trying to build back their workforce. They held on to workers, right? They did the labor hoarding because if they lost them, they would have a hard time getting them back. And now you're starting to see a change because the job market softened, making it easier for companies to kind of streamline. And you've seen it. We've talked about it, right? Like Amazon, UPS, Target, Meta, all making these different kinds of layoffs. The Wall Street Journal says they're a little bit more comfortable with layoffs because they have optimism over AI. They're trying to boost their profit margins. They need to eliminate workers that they feel they don't need anymore. So it's all about the kind of this change in the workforce that's starting to happen.
You know, I'd never heard of the term labor hoarding before this last few years. Never heard of that before. And I was like, but I guess it was a thing, kind of is a thing. But yeah, we're starting to see some layoffs. I just don't know if those layoffs are they systemic or are they just kind of one-off things? I'm not sure.
I think it's too early to know, but a lot of folks are already saying it's just harder to find a job.
Yes.
It's taking people longer to find that next job.
Although I still see a lot of...
Remember the Great Resignation? People felt really good about the next opportunity, so they were quitting in droves. That is not happening anymore.
That's not happening anymore. Okay. I still see a lot of help, for hire job signs out there. I don't know. We'll see.
Yeah, it's not those like higher position though, like corporate roles. I know. All right. This one is from Screen Time. Okay, Bloomberg Screen Time. It's a new trend in entertainment. Yeah, it's
Lucas Shaw.
Lucas Shaw talking about box office duds becoming streaming hits and how this is changing things. So he gave this example of the movie Madam Web. Right, it was a box office bomb. It bombed at the box office, but it was #1 on streaming during its first week. So it prompted Sony to kind of rethink things like whether their fees should be based on at least in part on how a movie performs online. Because right now, currently Netflix pays this fee per film based on domestic box office performance.
I think they're going to change that formula.
Since the ticket sales aren't always the best predictor, they're talking about asking, the next partner to share how many users, watch a film, how long they stay, do they finish it? They're starting to talk about things like that. So kind of changing the way that these movie companies are rethinking how they value their movies, basically.
But, I still think a movie has to be in the movie theater for a particular amount of time to be an Oscar contender. It cannot just go to Netflix and be up for an Oscar, which is a consideration for these companies.
Yeah, I think they're trying to change that as well.
That's right.
Let's see. Okay. What else we got?
Streaming's changing a lot of things.
I know, it is totally.
Okay, this one, I thought there's a good story. So this is in India. It's a milestone for women there. The national women's cricket team defeated South Africa on Sunday. They won their first ever World Cup title.
Wow.
So the bigger picture is because it puts the spotlight of, the role women play in public life there, the role women play in sports there. Because cricket, always popular in India, but for women, it's been like this journey to get to where they are. But it's from the New York Times. It really has this good look into how things change for women in the sport. Like around 2017, national players were kind of starting to get these regular contracts. So it allowed women to start, maybe I can pursue this as a career part,
Congratulations to them because they're really trailblazers there.
Yes, most definitely.
Yeah, and cricket is just crazy popular in that part of the world. And it's big time in India and in South Africa as well. All right, Lisa Mateo, thank you so much. Newspapers there, Lisa Mateo, bringing it to us as she does every day.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.